Hi, today I want to answer 10 most frequently asked questions about the stock market. So what is the stock market? How do I start investing in the stock market? What is a stock? How do stocks price change? What is stock market index or ETF? What is a bull market and bear market? What are dividends? What is the difference between stocks and bonds? What are risks of investing in the stock market? And how do I diversify my stock market investments? So the first question being, what is the stock market? A stock market is basically a place where you can buy little parts of the companies. So companies can issue their stock and you can buy it. The stock price will change. If the company grows in the long term, the stock price will also go up and you can make money in that way. So a stock market is a place where your broker will connect you to the stock market, where you can trade with other investors. So if you want to buy a stock, some other investor has to sell you that stock. And the stock market is a place for that to happen. How do I start investing in the stock market? So it's pretty simple. You need to open a brokerage account. You can use an online broker. You can usually also use your bank. Your bank is a little bit safer, but it will charge you commission. So if you have very little amounts of money, it might be better to just go with some broker that has very low fees. What is a stock? So a stock is a little part of the company. Let's say that company A has 100 stocks. If you buy 10 of those stocks, you will be a partial owner of that company. You will own 10% of that company. You have some voting rights connected to the stock, but obviously if you are investing in one of the biggest companies that are listed on the stock exchange, then there are millions and millions of stocks. So you will probably own like 0.001% of the whole company. But you are like partial owner of that company. You will earn money when the stock price goes up. And in the long term, the stock price reflects the change in real business. So if your business is doing well, in the long term, the stock price will go up. If your business is doing poorly, then the stock price in the long term will go down. In the short term, the stock market can be very volatile and based not on logic, but maybe on emotions like fear or greed. So sometimes in the short term, the stock price can move away from the real value of the business. So maybe the business can be doing great, but the stock price can drop down in short term, or maybe the business is doing poorly, but there could be a huge optimism on the market and the price can go up opposite to the real value of the business. The fourth question is, how do stock prices change? So that's quite important to understand. The stock price is determined by the amount of people buying and selling. If there is more buyers, then the price will go up. If there is more people selling, then the price will go down. So it's not connected in the short term to the real value of the business, just to the amount of people who are selling or buying. If more people buy, then the price will go up. Next question, what is a stock market index? There are usually you can invest into indexes through ETFs. So for instance, maybe you've heard about S&P 500, that's an index. So it's like one price, one instrument that is made out of 500 biggest companies in USA. So like small little parts of that stocks of those companies are all combined into one big index. For instance, you have the DAX 40, that's 40 companies from Germany. You have VIG 20, that's 20 companies from Poland, etc. Each country has their own indexes. There are indexes that are like this for the countries, but there are also ones that are more specialized. So maybe you can get an index that holds only the banks or only real estate companies or maybe only AI companies, etc., etc. Next question, what is a bull market and a bear market? That's a very easy question. A bull market is a period of time where the prices go up. So it's an optimistic time. People are greedy. there's a lot of money being made, the prices are going up. That's a bull market. The bear is the opposite of a bull. So a bear market, the prices are dropping, there is usually panic on the market, people are pessimistic, etc. It of course depends on the investor, because for me personally, I like to buy stocks during the panic, and I like to sell stocks during times of greed and optimism. Next question, what are dividends? Dividends are quite nice, some investors love them. Basically, the company makes money every year and they can send you that money. So for instance, you own some stocks, the company made some profit and they are going to share that profit with you. Some companies pay around 2% dividends, some other companies 5% dividends. I even seen companies that pay 10% dividends. So if you buy stocks for $1,000 and the company pays 10% in dividends, you will get a bank transfer to your account for $100 every year. It depends on the country. In Poland, they pay once a year, but I think in USA they pay twice or even 4 times a year. I'm not sure. I think twice. But basically, dividends are the share of profit that are paid directly to the investors. So if the company makes some money, they will share it with you. They will make you a bank transfer for that money that they earned. It's really nice. But it's not cost effective in terms of taxes, because if that company makes that money and reinvests it, so spends it all onto growing their business, they are not taxed. But if they pay it to you as dividends, then that money is being taxed. Next question, what is the difference between stocks and bonds? Come on, those are two completely different things. A stock is a thing that can go up and down in value, in price very quickly. The stock price is moving quite rapidly, it can be volatile, etc. And in the long term, the return on your investment in stocks is based on how the real business is doing, while the bonds work in a different way. They basically pay you interest every year. So for instance, you can buy a bond that will pay you 5% interest, and every year you will get that 5%. But the price of bonds, they also moves. It's based on the interest rates when you are buying government bonds. So when the interest rates go up, the price of the bond goes down. It also depends on type of the bond, but that's usually how they behave. They behave like that if the interest rate is stable. So if your bond pays 5% every year and the interest rates go up, so there are different bonds on the market that will pay more, let's say 7%, then the value of your bond will go down. But don't worry, if you hold it till maturity, so let's say you buy a bond that is a 10-year bond, so you have to stay invested for 10 years. At the end of that period, you will get your initial investment plus all the interest. You can only lose money investing in bonds if you sell the bond quicker, because then the price movements and the interest rate movements can change the price of the bond. But if you hold it till maturity, so if you hold it for the full period of 10 years in this example, you will always get the initial investment plus interest. So it's a very safe investment, especially in the government bonds, because you can also buy bonds from corporations and they are more risky. The 9th question, what are the risks of investing in the stock market? So the risk comes if you don't know what you are doing. If you buy something that is overpriced, you will lose your money. So if you buy a stock that is overpriced or the company is doing poorly, then you can lose money like this. The risk on the stock market is by some investors also tied to volatility. So what is like the probability that the price will drop 20%, for instance? That can also be risk. And the 10th question, how do I diversify my stock market investment? So I will actually start with saying, don't diversify your stock market portfolio. So for me personally, it's better to hold few stocks that are good than to hold 100 stocks that are, some are good, some are not so good. It's basically too much hassle to understand 100 companies. So remember, go for the value, go for the best ones, best opportunities. Warren Buffett says if he has 10 ideas and he ranks them, why should he invest any money in the 10th best idea and not in the first? So yeah, don't over diversify. It's of course very bad to hold all your money in one thing, but Warren Buffett suggests that as long as you don't hold more than 33% of all your money in one thing, then you should be fine. But also remember to diversify for market risk and sector risk. So for instance, if you are holding 5 different companies, but all of those 5 companies are doing the same thing, so they are working in real estate, they are building houses, then you are not really diversified. Maybe buy one company from Poland, one company from USA, one company from China that do different things. So remember about that type of risk also. Okay, so that's everything for today. Thank you very much for listening. If you liked the episode, please give me a follow, give me a rating. There are also polls on every episode. You can write a comment. I will gladly answer that. Thank you very much for listening. I hope you have a great day. Bye-bye.